everyone, welcome back from reading week. I really do hope that you had a great week. You were able to take some time and relax, and now hopefully ready to jump back in to chapter 5, which we will start looking at merchandising operations, which are companies that sell inventory. Okay, so what is a merchandising operation? We're just going to kind of start off with some information about these type of operations and what accounts we will look at now. In chapter 1 to 4, we mainly looked at service companies. So those were companies who earn revenue by doing services. Now in chapter 5 and 6, we will look at these merchandising operations. So companies who sell goods, that's how they earn their revenue. So what we've learned so far still applies, but now there's some new and extra things that we will take a look at. So merchandising entities, as I said, they earn revenue by selling products, which are called merchandising inventory, or just more simply, and what we'll refer to as just selling inventory. So this is different than selling services. Now you actually have a product that you are giving to a customer. Because of this, there's some new balance sheet and income statement items that we'll look at. We've looked at them a little bit, but now we'll look in more detail. So on the balance sheet side, the new account that we will be dealing with is inventory. And inventory is an asset on the balance sheet, and it's a current asset. So assets, remember, in general, are a resource that we have with a future economic benefit. And the benefit of inventory is that we will sell it in the future and we will earn cash, or we'll get cash for that. So that's why it's a benefit. On the income statement side, the accounts that we'll look at, and this is more in general, we'll get into more detail later, but we will see sales revenue. So obviously that's a revenue account. It's separate than service revenue. So you would have different accounts for these if the company did both services and made sales. So this is a new account that we will use. And it's the selling price that we're selling our inventory for. So whatever we sell it for, that's the revenue that we earn. The next account is cost of goods sold. So we did quickly look at a merchandising company in chapter 1, but we'll go into more detail about it now. So cost of goods sold is an expense. Remember that I've said that when an asset is used up or it's sold by the company and it's no longer an asset in the company, it becomes an expense. And that is the case with inventory and cost of goods sold. So when we still have the item and it's waiting to be sold, it's an asset to us. It sits in inventory. Once we've actually sold it, we move that cost into cost of goods sold. We've used up the benefit because we've already sold that, so it becomes an expense. Then the third thing that we'll see here is what's called gross margin. And this is a subtotal. So when you take sales revenue minus cost of goods sold, you get to your gross margin. So this is a subtotal of the two amounts above that. Okay, so we'll look a little bit more here on gross margin or gross profit. And it's a really important measure for a merchandising company and how successful the business is doing at making money when they sell those goods. Gross margin, as I said, is calculated or is equal to net sales minus costs of goods sold, or COGS. And net sales, as you can see down here, is calculated as our sales revenue. So this is the gross amount that you're selling it for, But then you could also have sales returns and allowances or sales discounts. And these are subtracted because they decrease this net or gross sales revenue to get to the net amount. So we'll talk about sales returns and allowances and sales discounts in more detail in a future video. So our gross margin, it's really how much a company is making just from the sale of their item. So you need to make money as a company, and the way you do that is by selling your inventory for more than it cost you. And that is the gross margin. So our net sales is the amount we end up selling it for, and then the COGS, that's how much we paid for it to get it into our possession. So the difference, that is the gross margin. Okay, so what is inventory? Well, inventory is the items that a business have that it expects to sell to customers. So it owns these goods and it expects to sell them to the customers in this normal course of business. So supplies is not inventory because we don't expect to use supplies. We expect to use it up within we don't expect to sell it. We instead expect to use it up within the company. So we're going to use it in our operations, but we're not going to sell it. Inventory is something that you're going to sell. So that is why the company has the operations to sell these goods in order to make revenue. As I noted earlier, inventory is an asset. It is reported in the assets section of the balance sheet, and it is a current asset because we expect to sell these items within 12 months, hopefully even less, but you're not going to purchase so much inventory that you have it for more than a year. So asset or inventory is a current asset. So what goes into the cost of inventory? And it's more than just what we purchase. So taking kind of a step back first and looking at just in general what goes into the cost of an asset. So an asset in general is the sum of all of the costs incurred to bring that asset to its intended use, net of all discounts. So if there's any kind of a discount available, you would subtract that. But it's all of the costs to bring it to its intended use. So if we now think about inventory, what is the intended use of inventory? Remember that I said we hold inventory in order to sell it to customers to make money. So the intended use of inventory is to sell it. And therefore, the cost of inventory, what goes into that, is any cost incurred to bring the inventory item to the point of being ready to be sold, which is its intended use. So any cost incurred to bring the inventory item to the point of being ready to be sold. To the point of being ready to be sold. And this is also net of any discounts, which we will also talk about in a little bit more detail in the future. So any costs that are directly incurred to get that inventory item so that it's ready to be sold. So you get it to your location, anything that needs to be done on top of that, and so it's sitting on the shelf ready to be sold. All of those costs will get added into the cost of the inventory itself. Once the item is ready, so it's on your shelf, it's available, ready to be sold, any costs related to it after that would be expensed. They no longer go into the cost of the inventory. So it's only getting it ready to be sold. An example of that, we can look here at what in cost might be incurred to bring a sleeping bag that's been made in Asia to a store shelf in Toronto. So the first part of it is the actual cost of the sleeping bag. So that's the original purchase. That's what we need to pay to actually buy that sleeping bag. But since we're buying it from a store or somewhere in Asia, we now need to get it to us in Toronto. So any customs or duties that need to be paid to the government to bring this item into Canada, those are also included in the cost because we need to pay those to get that item here so that we can sell it. As well, any shipping costs. So if we're paying shipping to get it from the manufacturer in Asia to the store in Toronto, that is also a cost of getting that item to us ready to sell. So we also include that. And then the last one here, it says, is insurance during transportation. So if it's coming from Asia, perhaps it's on a big ship and we're bringing it across the ocean. If we're doing that, we're going to have some insurance just in case something goes wrong. So while it's being transported, that's still a cost to get that item here to us ready to sell. So that would also be included. Insurance on the item once it arrives and is on our shelf in Toronto would then become an expense. It wouldn't be part of getting that item ready to sell anymore. But while it's going through transportation, we're still paying that in order to get it here. We would include that. So total cost here, $59. It includes all of these costs to get that item ready to sell. Okay, so now we know a bit about inventory and cost of goods sold and sales revenue. And we're going to take a look at these two inventory systems. So there's two main systems, the perpetual system and periodic. And the perpetual system is our focus. We're only going to talk a little bit or a minor amount on the periodic. So as we go through, I'll let you know what you do need to know on the periodic, but you won't need to know journal entries from that system, just a few calculations. But we are focusing on perpetual, so you need to know all of the things on the perpetual system. So perpetual, as it says below here, it keeps a running record of all inventory as it's bought and sold. So this means that it's always up to date. Every time that we buy some sort of inventory or we sell an item, you update the inventory account. So we're continually tracking that. We have this running record. Every time something happens, we update the account. Periodic, on the other hand, does not keep a running record of all of the goods bought and sold. Instead, you only update it periodically. So you only do this once the inventory is counted. Now, it may be counted once a year, at least this will be done, but it could be counted more often than that. So whenever the company counts, they then update to that counted amount. Perpetual, it's always up to date because every purchase and sale we're tracking through there. Periodic, you only update when you do the count. And to note, even under perpetual, while we're continually updating that, we still count our inventory once a year. So you're always going to do this count to make sure that whatever you tracked is up to date under perpetual and that you can update your periodic. Okay, so that is a quick look at the two different systems. And in the next few videos, we'll dive into the perpetual system and how that works.